One thing I covered in that presentation is that we've crossed over 100 trillion debt, which includes public and private debt. So that's kind of total debt in the American system. It's obviously higher than that when you look at globally. One of the things I pointed out too is that the number of years that they've ever gone down is extremely low. So in the entire kind of period that we've been alive, and even our parents have probably been alive, the total debt in the U.S. only fell one time, and that was 2008 during the global financial crisis, and it only fell by 1% before they started money printing. Um, and if you look at the longer data set, going back all the way to the creation of the Federal Reserve over 110 years ago, there were 4 other years where total debt went down, and they were all in the Great Depression. So 1930 to 1934, and then that got too painful for them, so they printed. And so 5 years out of the over a century where they ever led complaining. What's the issue? And if you're not on the right side of those deficits, you're getting squeezed pretty hard because you're getting all the debasement associated with those deficits, but you're not on the receiving side. So you're getting diluted. There's kind of this value being transferred away from those people and toward others in a fairly opaque way. So how bad it's going to get depends on how either fortunate or unfortunate you are in the stack, and then also what you're doing, be aware of it, and then protect yourself from it, which is why I do what I do and try to educate. When did the UK lose their reserve currency status? There's a couple milestones that were important, but none of them were like the day. And so there was a period of time where the U.S. surpassed, the biggest economy in the world. Um, then Bretton Woods moment was obviously a huge moment, but UK debt was still pretty widely held. Then there was the Suez crisis, where the UK lost political clout, and then it's really been a long grind of losing it ever since. There's still a reserve currency. The U.S. dominance period was an anomaly. So after World War II, the U.S. was over 40% of GDP. Most of the world was destroyed. The U.S. had by far the most gold, biggest manufacturing base, really strong demographics, by far the biggest military. Homeland was mostly unscathed by the entire war, and so it was just like a hyperpower position. And so everything was kind of built on top of that. And over time, we've fallen from over 40% of GDP to 15 to 25%, depending on whether you're looking at nominal or purchasing power parity GDP. We're no longer the biggest trading partner. And so as you kind of go by different metrics, we've been shrinking. But there's really no other currency block that's going to recreate that 40% of GDP hyper dominant situation. And I mean, if anything, that's a healthy thing. That was an anomalous period where like most of the rest of the world was destroyed. And if you look at kind of long run history, like China and India used to be pretty big percentages of global GDP, stretching back a very long time. But in the era of kind of Western exploration and colonialism and stuff, I mean they were on the wrong side of the technology war that happened, so they radically shrank as a percentage of global GDP despite their large populations. And if anything, the recent return of India and China to rather large chunks of global GDP is asset, something held by, like, say, a central bank, is meant to be there when you need it. If you need to say one or two things, either you sell it to buy back your own currency to strengthen your currency in a currency crisis, or if, like currently, if there's a lot of dollar-denominated debt in the world. So there are banks and there are corporations and governments around the world that have dollar-denominated debt. And in a dollar shortage, like let's say, for example, when pandemic lockdowns happened and all the global trade dried up and all the dollar flows contracted, but these debts were still owed, having dollars at the sovereign level in some way is useful because then they can loan them to their domestic entities that owe dollars and keep their debts solvent. So either to backstop the currency or to backstop their offshore debt liabilities. And so that's generally a large liquid asset like gold as a reserve asset, or more commonly, dollars and treasuries. Bitcoin being small and generally also being something that there's not a lot of liabilities denominated in, it's less going to be picked in the near term by central banks because they can't say, look, in 18 months from now, if we have a currency crisis, if Bitcoin's cut in half relative to what it is now, that impairs our ability to defend our own currency. The volatility is kind of too much for that kind of reliable need that is required. And instead, where we find it is creditor nations have big sovereign wealth funds because you kind of had a few years of a bear market afterward. They hit very high levels by that metric. Currently, we've not hit anywhere near the levels that are historically associated with multi-year drawdowns. There are times we hit, I would call it moderately frothy. So, for example, in March 2024, which was the near-term aftermath of the launch of the US spot Bitcoin ETFs. So there's a little bit of a fervor there, a little bit of a rapid price jump. We briefly touched new highs at something like 73,000. And that metric got a little bit frothy, but it was nothing like one of those, multi-year periods. And then we did end up consolidating for like 7 months, which makes sense given the moderate froth we had. Then, shortly to your point, right after October, when we had an election in the U.S., a much more favorable environment to Bitcoin. That was kind of a catalyst, but that was after a 7 month consolidation. We were in a pretty good space valuation wise. We jumped up to, what was it, 107,000 or 108,000 thereabouts, and that reached similar levels of like moderate froth. So again, from November until, and my guess is that we'll see more prolonged but less explosive movements. Now, we could hit a turning point where you do get another explosive moment. And if I imagine how the end of this quote unquote cycle looks, I have to kind of look at the leveraged Bitcoin companies and say, well, maybe it kind of hits a little bit of a temporary escape velocity, gets really frothy for a period of time. A lot of less well managed companies enter the space, don't term their debt out very much. And of course, leverage is how you kind of blow something up that otherwise is pretty sound. And then we roll over and you get forced selling by some of the worst managed companies in the downturn. So that's kind of what I see on the horizon for a potential end of cycle catalyst, but it's too early to say. And I would just treat every cycle as different.
The more the asset is going to mature, the less it's going to be volatile in either way, right? We will see less violent move on the upside, but also the corrections are going to be smaller because the asset is maturing. And it's only Bitcoin via, I say, proxy. So let's say if you buy an ETF or if you buy MicroStrategy or anything, or 21 now, Nakamoto, we have a lot of players now coming in the market. Do you think it's a good thing or is it a bad thing?
I think it's a neutral thing in the sense that I view it as inevitable. Privacy technologies are being supported, kind of the more cypherpunk aspects of this. And I don't think it's a zero sum game. I think the corporate side can do well. And if anything, that gives more fuel for some of these other areas. But it is important to monitor these other areas to make sure they're not being neglected at the expense of some of the bigger entities.
Thank you so much for saying it, because we wouldn't have Bitcoin at $100,000 without certain players involved. And who are we to forbid someone to use a free and open network? I mean, it wouldn't be free and open after all. If we say, okay, banks can't use it, ETFs can't buy it, well, then it's not free, it's not open, right? So everyone should be able to use it. And if you are afraid, quote unquote, well, just get self-custody, right? You still have the option.
Exactly. I think it's all about optionality. And the analogy that I've used is like cars. There's some people that like back in like the early US and globally when cars were taking off, they became a symbol of freedom, which is that once you had your own car, you could drive anywhere. You weren't reliant on public infrastructure as much. You could drive anywhere in certain realities of getting gasoline and stuff. So it's somewhat of an illusion, but so it is good to make use of the unique aspects that the network offers where possible. The actual importance in practice can vary. So if you're like a private company in an exchange, it's probably more important for you to do that. Whereas, from Saylor's perspective, he is a large publicly traded company with very exacting auditors that are extremely thorough. Not to say that they're impeccable, that they can't be questioned, but it takes a lot of fraud at that level to like say not have the Bitcoin or something. And so I can see why it's just not something that they feel like they're focusing on, because the type of investor they're catering to, the larger people that are active in capital markets, people that are like institutional investors, people that are high net worth retail investors. Part of why the S&P 500 and the Nasdaq are kind of equity gems for the world to invest in is because they choose that for their own jurisdiction. I mean, America has literally made it illegal to own gold for 40 years. I mean, we have these kind of crazy precedences, many other jurisdictions as well. So you have to kind of judge the risks of that, but it depends on the size of capital that you're operating with, and then it depends on what jurisdiction you're in, and it depends on. And some people will split the difference. So say, look, for my retirement account, it kind of needs to be in this little walled garden. So I at least want some Bitcoin exposure, so I can buy the ETF, or I can buy the Bitcoin Treasury company. And for the more free money, the free range money, they buy a hardware wallet and own their own coins.
And speaking of gold, I mean, do you think gold has a play in someone's portfolio in 2025?
I think so. I mean, I've held gold for years now. It's done better than the majority of investments. It's obviously not caught up with Bitcoin, but I didn't intend it to. I think there's a couple ways to look at it. One is the typical investor has liabilities or obligations, and so there's a certain volatility tolerance that they have, in addition to a psychological volatility tolerance. And so, even if they're high conviction on something, they might not get dollars, and so they matter for a lot of offshore places that want dollars. And if you think of kind of two main ways that dollars can get into a country, one is physical, ports of entry, which are highly surveilled and limited, and then there's through banks, which again, the government can determine what the official exchange rate is for all their kind of cross-border bank transfers. They can determine whether customers in their country can even access dollars from their bank, should the bank have them available. And stable coins basically say, well, you can memorize a few words or write the digital gold and by extension digital cash, and but that has to bootstrap a very long network effect. And there are people that they want to say buy something to protect purchasing power from, like you said, there's very high inflation in many places. They let's say they have 10% inflation a month. They don't want to have that degrade them, but Bitcoin can fall 10% in a month and more in many cases. And if they have kind of end of month liabilities, they're not necessarily wealthy. They can't withstand a 10, 20, 30% drawdown on their assets. And so they'll, dollars can suit that period of time where they need obligations to basically meet obligations over the next month or 3 months or 6 months. But once you get to the point where you can withstand more volatility and plan longer in the future, that's where scarcer assets with more appreciation potential makes sense. So that's gold and historically, or equities, real estate, art, and now I would say the apex one is Bitcoin.
I think we will see many other countries going for the jugular versus.
Like, subscribe, and turn on notifications. Support the channel by liking this video, subscribing, and enabling post notifications for more content on crypto and digital assets. Check out our other videos and share your thoughts in the comments below. Your engagement helps with the YouTube algorithm and keeps the content coming. Thanks for your support,